This boring ICT strategy made me over $2.5 million in third-party verified profits after years of failure, and I'm about to show you exactly how. I've been trading ICT for 8 years, and in that time, I tried dozens of complicated strategies, and this was the one that finally made me profitable. Today, I'm going to break down all 3 steps of the strategy so you can use it to become a profitable trader. The goal of this strategy is to distill ICT concepts into what actually matters, because 95% of it is just going to confuse you. Now, this first part is stupid simple, but if you mess this up, nothing else works. So let's first talk about choosing a direction. Now, the importance of choosing a direction and identifying where the market is going to go is because if we get it right, we should be paid. So one of the first things that I look at is market structure. So is the market creating higher lows and higher highs, or is it creating lower lows and lower highs? If it's creating higher lows and higher highs, we can just assume that the market is in a bullish market environment. And if it's creating lower lows and lower highs, we can assume that the market is in a bearish market environment. So to simplify this as much as possible, think about markets just going in 3 main directions. It's either going up, going down, or it's going sideways. So when we try to identify a bullish market structure, this market can go up and down, but it's usually not going in a straight line like this. And when we're trying to pick out are the areas where it pulls back, this is really where we're trying to position ourselves long for the market to continuously drift higher and higher. And vice versa, if we're predominantly bearish on a market, we're expecting the market to create lower lows and lower highs and position ourselves on these pullbacks as the market drifts lower. So when it comes to analyzing this specific market in 2023, we can see that it was in a major bullish trend. And yes, there were pullbacks along the way, but even with these deep pullbacks, they're still not creating new lows in the market. And it's our job to understand and say, okay, this market is moving lower over time. Let's just say from mid-February up until mid-March, this market is in a short-term downtrend, but eventually we get a higher low printed here and it starts to move higher again. And likewise here for the bearish example, you can see here that it's creating lower lows and lower highs. And we recognize that this market does have short-term rallies like this one in here, but overall it's still creating a lower high compared to these previous highs. So again, the first thing that I try and determine is this market creating higher highs and higher lows, or is it creating lower lows and lower highs? And if the market is unclear if it's making higher lows or higher highs, or lower lows and lower highs, and it's just kind of chopping around sideways, then I don't even move on to the second step of identifying the direction. But let's say it's clearly identifiable in one of these short-term rallies. So here we have a low, a high, a higher low, a higher high, a higher low, and this market is continuously trending higher and higher, and it's easy to identify that we are in an uptrend. The next part of identifying the direction, and I do that by looking at fair value gaps. So if you guys don't know what a fair value gap is, it's basically a 3-candle pattern where we have candle 1, candle 2, and candle 3. You guys can see here that we have a bit of a gap from this wick to this wick here. And all of this price action in here now becomes our fair value gap. This essentially just represents an imbalance between buyers and sellers. So if bullish fair value gaps are being respected and bearish fair value gaps are being violated, we can determine that order flow is currently bullish. So if we just zoom into this chart right here, I've marked out a bunch of different bearish fair value gaps and bullish fair value gaps. You guys can see that the bullish fair value gaps are being respected. Meanwhile, the bearish fair value gaps are being violated, meaning we're trading and closing through them. So each time we get a bearish fair value gap, it's violated on a closure above that specific level. Now, there are more fair value gaps in this chart, but I've only plotted the ones that really jump out to me. And opposingly, if bearish fair value gaps are being respected, but bullish fair value gaps are being violated, then the order flow is currently bearish. So here we can see a ton of bullish fair value gaps. Once we get this bearish fair value gap though, it starts violating all of these levels in here. Now, as you can see, each time we get a closure through those levels, the market continues lower and creates lower highs and lower lows. Now again, if market structure and order flow are unclear, then we have no real direction and no trades. Alright, now we have the market direction, which is great, but pretty useless if we can't execute trades consistently. Which brings us to step 2 of the strategy. Now, if you've ever been stopped out only to watch the trade rush in your direction afterwards, then this is for you. After you learn this simple concept, you'll never be faked out of a trade again. Alright, so let's talk about how each day is actually formed, and I'm going to simplify this as much as possible. So on a bullish day, we have an open, a low, a high, and a close. So the lower part of the body of the candle is our opening price. This wick down here represents the lowest price that it traded on the day. The wick up here represents the highest price that it traded on the day. And then the top of the body of the candle represents where it closed on the day. Now, let me try and break down how you're trying to position yourself in the market. And this is something that really transformed my trading. So on a bullish day, my goal is to buy it as close as possible or below the opening price. Because if I'm anticipating the market to close higher, who's going to get the the best price on the day? Is it the person that's going long right at the open or below the open? Or is it the person that's going long after the candle has already flipped bullish and pushing towards the high of the day? So let's just assume, for example, that I'm entering at the open and John is going to enter after the market is already trading in the direction that we're expecting. All right, out of mine or John's orders, who gets the better fill price on the day and is able to extract more profits from the markets with the least amount of risk? Obviously, in this example, I would benefit from entering at the open compared to John waiting for the candle to already turn bullish because I'm buying it at a discount. So let's just assume that the opening price is $5, right? And John is entering at say $7.50. And then this market actually closes where? At $10. So let's say it opened at $5 and it closed at $10. Who makes the most amount of money on this specific day? Kyle or John? Clearly I have, because I made $5 profit on the day. Meanwhile, John has only made $2.50. And let's just assume that our stop loss is all the way down here, and the price of this stop loss is going to be $3. So I'm entering at $5 and my stop loss is $2, right? So if it goes to $3, I get stopped out and lose $2. Whereas if John enters and he gets stopped out, right? We're using the same stop loss. He's losing $4.50. Okay, so John is losing almost twice as much as I am. So from a risk to reward perspective, you are trying to buy the candle before it expands. And if I sit down in front of the charts and the candle has already expanded, I typically will not take a trade. So on a bullish day, I'm trying to buy it at or as close to the open as possible, ideally below the open. And on a bearish day, I'm trying to sell it at or as close to the open or ideally above the open if I'm anticipating a bearish candle. All right, so now you know how to find out which way the market's going and how to avoid fake outs, but how do we actually make money and find the best trades? Now this brings us to step 3, placing the trade. So for the entry, we're trying to keep things as simple as possible. We're looking for a sweep of liquidity that might be an intraday high or low, session high or low, or previous day high or low. And then we're just going to enter on a fair value gap with the expectation that the daily candle is going to close higher or lower. So in this one example, you guys can see here our midnight open, and leading up into a news release, which I believe this was NFP, you guys can see that we took out sell side liquidity into this fair value gap. And also note that this is our daily open. So this trade meets all of our criteria. Maybe we had our market structure and our order flow already predetermined coming into the day. What we're trying to do is buy it at or below the opening price as closely as possible. Now, if you sit down in front of the charts and the market is already trading all the way up here, I am less likely to take on that risk because look how far we are away from the daily open. When you sit down and backtest all of your trading data, you will realize that on the most bullish days, oftentimes the best buying opportunities are going to occur at, low, or very close to the opening price. And if the daily candle's already expanded, you are assuming more risk. Now here's just one more example. So let's assume we have a bullish bias coming into this day. Maybe the higher time frame market structure is still trading higher. And again, if we're anticipating this daily candle to close bullish on the day, we're trying to buy it at or below the opening price. And we're looking for a raid on liquidity. So we have our raid on our London session lows here, trading down into this fair value gap. We get a nice rejection. So really anybody that's going long after the sweep of this, it doesn't really matter if you're entering it here, 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 anywhere below or at the daily opening price. At the close of the day, everybody that entered around these prices will close the day in profit. You now have the same strategy that I used to make millions of dollars and change my life forever. But chances are you've probably had profitable strategies before, but still didn't become profitable. And I get it, because I failed for 10 years before I was able to make it work. But once I did, my life changed forever. Please guys, whatever you do, just stay consistent with this, because trading really can change your life if you have the right system. I recently opened up spots to my inner circle where I trade with my students, give them my full system, and coach them to become successful traders and overcome the hurdles that are keeping them stuck. Due to this being a direct mentorship, I only work with a limited number of traders. If the link in the top of the description still works, then slots are open. If not, then feel free to apply for the next enrollment. Thank you guys for watching, subscribe, and I'll see you in the next video.